Welcome to The Explainer. Today, we're going to break down a huge systemic issue, one that seems kind of distant, but is actually a direct threat to the very foundation of how we all invest. We're talking about the sovereign debt crisis and why the safest asset in the world might now be your single biggest risk.
It all starts with a number that's so big, it's hard to even wrap your head around it. $100 trillion. And no, that isn't just the official national debt you hear about on the news. This is the estimated scale of all the promises, things like Social Security and Medicare, that the U.S. government is on the hook for, but that aren't officially on the books. It's this massive liability just lurking in the shadows of the entire financial system. And this gets to the heart of the problem we're exploring today. See, the government is caught in a trap. It has to borrow trillions of dollars year after year just to keep the lights on. But when your debt is this high, the old rules just don't apply anymore. Really, the only workable path forward for the government involves a tool that directly eats away at your wealth, inflation. And that, right there, is why this matters so much to you. Okay, so let's dive in. Here's the roadmap for today. First, we'll get a handle on the real scale of the problem. Then we'll look at the two main tools the government has to manage the economy. After that, we're going to pull back the curtain on the money printing machine itself. Then we'll bust the myth of the risk-free bond, see how this all connects in a systemic crisis, and finally talk about how to navigate this whole new reality. All right, first things first, we have to understand the sheer size of this thing, because pretty much everything that happens in the markets, from stock prices to your 401k, it all happens in the shadow of this massive sovereign debt. The numbers here are, they're pretty sobering. The U.S. is running an annual deficit of over $1.6 trillion. That means we're spending that much more than we bring in with taxes every single year. Our total debt, when you compare it to our entire economic output, that's the debt to GDP ratio, is getting close to levels we haven't seen since the end of World War II. It's so serious that the government's own watchdogs, the CBO and the GAO, have both flat out called this path unsustainable. That's not a political opinion, it's just accounting. And a problem this big creates what we call systemic risk, where the failure of this one piece could actually threaten to bring down the whole system.
So how does a government even begin to deal with a situation like this? Well, it basically has two big levers it can pull to try and steer the economy. And believe me, understanding the difference between these two is absolutely critical. So on one hand, you've got fiscal policy. This is Congress's turf. They're the ones who decide on taxes, how much money to take out of the economy, and spending, how much to put back in. It's basically the federal budget. Then, on the other hand, you have monetary policy. This is wielded by the Federal Reserve, our central bank. The Fed doesn't tax or spend. Instead, it tries to control things like inflation and employment by messing with interest rates and the overall supply of money.
Now, to really get the government's problem, we need a quick way to think about GDP, or gross domestic product. Honestly, the easiest way is to picture a giant economic pizza. That pizza represents everything produced and earned in the entire country in a year. All the profits, all the salaries, everything. And the government, through taxes, gets to take a slice of that pizza.
And here is the fundamental problem. What happens when that pizza gets smaller, like during a recession? Well, the government slice, its tax revenue, it also gets smaller. But its expenses? They're pretty much fixed. Spending on huge programs like Social Security, Medicare, and national defense doesn't just shrink because there's a recession. So when your income drops but your bills stay the same, you get a deficit. A big one. And that deficit has to be funded, somehow. So how on earth does the government cover that massive gap between what it spends and what it earns? Well, this brings us to the very heart of the machine. And this, my friends, is where things get really, really interesting.
It's basically a three-step dance. Step 1, Congress spends way more money than it brings in. Simple enough. Step 2, to get the cash it needs, the Treasury issues bonds, which are just IOUs. You give the government $1,000 today, and they promise to pay you back later with interest. These bonds get sold to anybody and everybody. You, me, banks, other countries. But here's the crucial third step. The Federal Reserve steps in. It creates brand new digital dollars literally out of thin air and uses that new money to buy up huge amounts of these bonds on the open market. We call this quantitative easing, or QE. It's all done to keep interest rates low and make sure the government can keep borrowing cheaply.
This whole cycle has a fancy name, monetizing the debt. It's a technical term, but the concept is dead simple. It's printing money to pay the government's bills. Now, it solves the immediate cash problem, sure, but it has one massive side effect.
It floods the economy with more money, which makes every dollar you've already saved worth a little bit less. That's inflation, and it's basically a hidden tax on all of us. Okay, so with all that in mind, we can now tackle one of the biggest, most fundamental beliefs in all of finance. This idea that US government bonds are a risk-free investment. So let's just ask the question straight up. If the US government can literally print the dollars it needs to pay you back, meaning it can never, ever technically default, where's the risk? How could you possibly lose money on something that's guaranteed to be paid back?
See, the risk isn't that you won't get your money back. The risk is interest rates. Think of it like a seesaw. On one end, you have interest rates. On the other, you have the market price of all the bonds that already exist. When interest rates go up, the price of existing bonds goes down. It has to. Imagine you bought a bond last year that pays you 2% interest. But today, the Fed has raised rates and brand new bonds are paying 5%. Now, who in their right mind would buy your old 2% bond for full price? Nobody. The only way you can sell it is to offer it at a big discount. Its price has to fall.
And look, this is not some abstract theoretical risk. Just look at what happened to Silicon Valley Bank. They collapsed for this exact reason. They loaded up their balance sheet with what they thought were super safe government bonds when interest rates were basically zero. But when the Fed hiked rates faster than ever, the market value of that bond portfolio got absolutely crushed. It wiped out their capital and kicked off a massive bank run. And here's the craziest part. Banking regulations, specifically something called the liquidity coverage ratio, or LCR, actually forced banks like SVB to hold these government bonds as safe assets. The very rule designed to prevent a crisis ended up creating the perfect conditions for one. Their safe assets became their downfall.
All right, now it's time to connect the dots. We've seen the government's debt trap, and we've seen the hidden risk in the bond market. Let's see what happens when these two forces collide and the shockwaves spread through the entire system.
So here's the chain reaction, the dominoes falling one by one. The Fed raises interest rates to fight inflation, the very inflation that was caused by all that money printing. As we just saw, this crushes the price of existing bonds. Any bank or fund using borrowed money, leverage, sees those losses get magnified. At the same time, higher rates make it more expensive for companies and people to borrow money, which slows down the whole economy. And for stocks, higher rates mean that a company's future profits are worth less in today's dollars, which pushes stock prices down. And the terrifying result of all this? Both stocks and bonds, the two pillars of a diversified portfolio, can fall hard at the same time for the exact same reason. You know, it reminds me of that famous quote from the economist John Maynard Keynes. Markets can remain irrational longer than you can remain solvent. A hedge fund called Long-Term Capital Management learned this the hard way back in the late 90s. It was run by Nobel Prize winners, genius-level guys. They used incredible amounts of leverage on bond trades they thought were totally foolproof. But then a crisis hit and all of their supposedly separate bets went against them all at once. The fund blew up and almost took the entire global financial system down with it. It's just a brutal reminder of what happens when you combine leverage with risks you didn't even know were connected. And the pressure is just building and building on the government itself. As interest rates go up, the cost to just pay the interest on the national debt explodes. I mean, look at this chart. We are getting scary close to the point where the annual interest payment on our debt will be bigger than our entire national defense budget. And that's not an optional expense you can just cut. You have to make that payment. This is the fiscal trap in action, and it just keeps getting tighter. So, given this new and, let's be honest, kind of scary reality, how should you even begin to think about protecting your money? And maybe even growing it? Let's start with a brutal truth. For decades, we've been told to just diversify between stocks and bonds and we'll be fine. But in a systemic debt crisis, that strategy can become what some people call diversification. Why? Because when the fundamental driver, in this case interest rates, causes everything to fall at once, your diversification between paper assets gives you zero protection. They can become almost perfectly correlated, crashing together. So, what are some principles you can use to navigate this? Well, first, and most importantly, you have to understand the risk. Government bonds are not risk-free. Second, it might be worth considering hard assets, things that have a low correlation to the dollar and the financial system, like real estate or maybe commodities. Third, focus on investments that actually produce tangible cash flow. In a world of financial engineering, real actual income is king. And finally, limit your leverage. As we saw with Silicon Valley Bank and LTCM, when the system gets shaky, a lot of leverage is what turns a bad situation into a total catastrophe. And we'll end with this question because it really gets to the core challenge we're all facing. In a world where the most powerful governments on Earth are basically forced to devalue their own currency just to manage their debts, what does the word safety truly mean anymore for your savings? It's a question every single investor now has to answer for themselves. Thanks for joining The Explainer.